Morning, everyone. Steve Hamilton, would you take the roll, please?
Good morning.
Morning.
Treasurer Ma, welcome. Mr. Rosensteel? Ms. Yamamoto?
Here.
Ms. Dillon?
Here.
Ms. Hendricks?
Here.
Ms. Vargas?
Here.
For the Director of Finance, Ms. Wong Hernandez?
Here.
Controller Yi?
Here.
Mr. Chairman, you have a quorum.
Thank you, Mr. Hamilton. Before we begin, I'd like to acknowledge and recognize our newly elected State Treasurer, Fiona Ma, who is a member of CalSTRS. Welcome to the Investment Committee and congratulations on your election. Look forward to working with you. And I'd also like to acknowledge Kirsty Jenkinson, our new Director of Corporate Governance.
Yay.
Welcome, Kirsty. We look forward to working with you as well. Item 1 on the agenda is the approval of the committee agenda and work plan. And before I do that, I really would be remiss. This is not a going away celebration for Dana because she'll be with us the entire year. So we're not going to do that. But Denise Bradford will be our new member of the CalSTRS board. Denise, would you stand up? Denise serves as the chair of the California Teachers Association's Retirement Committee and is the president of a local in Orange County. And what an accomplishment, Denise. And I know it's a few months out, but we look forward to working with you and getting to know you over the months and years ahead. So congratulations on that victory. That's great, great news for all of us. Yeah. You're welcome, Denise. Okay, item 1 is the approval of the committee agenda and work plan. All those in favor of approval?
Aye.
Okay, thank you. Item 2 is the minutes from November 7th, 2018. I know that there is a
Steve to do it.
Yeah, Mr. Chair, I just want to point out.
yeah.
On INV 10.
Yeah, I'm on it.
Item 5, the voting, unfortunately, represents a vote of both aye and nay for Ms. Pigwin on behalf of the controller, and it should be nay.
Correct, yeah.
Yeah, so my
So,
apologies.
thank you. With that amendment to the minutes, entertain a motion for approval.
So moved.
It's been moved.
Second.
Properly second. Any objection? Without objection, the minutes have been approved. Item 3 on our agenda is an overview of our portfolio, and this is our CIO, Mr. Christopher Ailman. Christopher, good morning, Chris.
Thank you, Chair. Thank you, Harry, and welcome to our State Treasurer, and congratulations to the Controller on her victory and the new board members. So I do this in February as kind of an overview of the investment portfolio. I think what we'll do, since we still have some open positions, is we'll shoot a video that kind of summarizes what I'll say to you today, and then have that available for the board and the public to kind of get a history. But my goal, if we can bring up those slides, my goal is really to run through this fairly quickly. The information is all presented to you, but just give you kind of a synopsis. As Karen said in the earlier governance committee, it's a $220 billion portfolio, and there's a reason it's complex. It is global, not surprising, and it does take time to get to understand it. So this is kind of a very high-level overview of the history and the policy structure. I won't go into this in details because the Fiduciary Council and Brian as General Counsel will review this numerous times with you, but your legal mandate as trustees is set in the Constitution, and it's very clear. You have primarily 3 goals as it relates to the investment portfolio, which is to diversify the assets, minimize the risk of loss, but also to focus in on the benefit of the beneficiaries, which includes the employers, and keep the cost of the system, and not just the investment portfolio, but the cost of the system as low as possible. This slide came from Harvard, and it's way back in the 70s, but it's easy to think of a retirement system as basically a bucket of water. You've got 2 sources of water coming in, the contributions, which are now set forth in the funding plan, and then investment returns. The water level is kind of the funding level, and then we pay out benefits. And if you want to take it a level further, you can talk about the evaporation on the water is the expenses of the system. But the goal for you is obviously to make that bucket 100% full all the time. We're not there yet. The contributions are set. So what really can change is the investment results. And you get to decide how much you want to take risk to open that spigot. But basically, the investment returns have to double the contributions over the lifetime of a teacher. So it's easy to think about that. That's why for us, we spend so much time on that asset allocation wheel, because that really is what drives that pipe coming into that bucket. Here's the history of our funding status, and I think it's always important to know where we came from. As you said earlier, when board members are getting on, what's the history here? What's the past, so you then know going forward? The teachers' plan in California was historically very underfunded, and I have found that that's very true of most teacher plans around the country. They tend to be more underfunded than the public employees plan. And you can read into a million reasons why that might be true, but a lot of the teacher plans struggle. Not all, but a lot do. And the goal is roughly to be between 80 to 100% funded. 100% funded is properly funded. Below 80 is an emergency level of concern. And you can see, I could take this all the way back through our 100-year history. We were only fully funded for a brief 3-year period, and that was after the amazing stock market of the 80s and 90s, kind of like a rapid winning streak at blackjack, and naturally it turned and came to an end. I highlight the fact that where we are now is very similar to where we were back in 1988. I think it's interesting, the 30-year return, which I'll talk about in my CIO report, the net return for the fund is about 8.2 over that 30-year period. So you've earned pretty close or above your actuarial assumed rate. So you're pretty much back to where you were during that time period. But what has changed is the liabilities have gone up because, lo and behold, people are living longer. And so those are the things you have to look at, is not just the investment side, but the liability side. But our goal is to get back, obviously, to 100% funded. Here's the growth of the portfolio. It obviously has been massive over time. I like to point out that when we separated from CalPERS on the investment side way back in '83, we were basically just barely a $10 billion plan. Nowadays, that's typical of cities or smaller counties. And it's amazing how much we've grown, but what you got to realize is that at 7%, our portfolio should roughly double every 10 years. The power of what we call the power of compounding, the rule of 72. If you earn 7.2%, your money is going to double every 10 years. If you can earn 10%, your money will double every 7.2 years. But even net of our cash flow, this $200 billion plan would expect to be around $400 billion, a little more than a decade from now. The investment beliefs are in here. I'm not going to read through them, but that really is, the board spent a lot of time in 2016 and 2017 of going through those and crafting that language. That's what's going to always drive the overarching policies. And as was mentioned, that really is going to be the key governance document for everything we do. I want to show this, the investment return, because you can pick up just from this graph, obviously the big red jumps out at you, but sort of the upper blues. Prior to about 1982, we didn't mark the portfolio to market. The government accounting rules were different, and you basically clip coupons. So the investment history really starts until you marked to market and really measured how things were. Plus the law changed. Before '84, you were under a legal list. The legislature would basically approve what kind of investments the fund could make. '84 is when the citizens passed a statewide proposition that changed your mandate to a prudent person standard, prudent professional standard. So that's, even though we can go back to the 1950s and 40s in returns, this is your more recent investment return. And I guess a couple things I want to draw to your attention. One, obviously variability. You do have negative years. You can see 01, 02. You can see 1987, 94, and then obviously the big drawdown in 2008. But also look at the positive years. What's amazing to me and not uncommon is that green line is what we're assuming the portfolio will generate. If you notice, it never hits that. So when you think about an average, your statistics, a mode, a median, it actually never averages 7. It's either way above or way below. And that's the volatility we have to live with. And that's what we'll get into in the asset allocation. It really certainly, as you can see the blue line, the 3-year average return, 3 years is a pretty short period. And after we lived through the 80s and 90s, the 2000s have been much more volatile. Sometimes we really beat the 3-year average. It's above the actuarial rate. Sometimes it's below. That impacts your funding. That's what's causing that funding pressure back and forth. I'd love to go, I think PERS once went to a 15-year average or a 30-year average, but you find you can't live life on 30-year time periods. People want more current signals on how things are going. A busy chart, but this is in your books, which is your investment policy. It's kind of a large graph of the investment policies. I wanted to highlight, let me get to that right page so I can direct you there. INV, sorry, I should have highlighted that. There we go. INV 63. It's important to know you have 2 investment policies, one for the defined benefit plan and then one for the defined contribution plans. Under the defined benefit plans, because they're so large, you have a whole series of policies. And you'll be going through those at different times. They're all approved by you. They sometimes come back each year. Some don't come back for 4 or 5 years. There are 2 policies I'll note that are quite, that need to be moved, the infrastructure policy and the commodities policy. We had 2 policies that were 10 years old and we just recently dealt with those. So I'm very proud of the policies here at CalSTRS. They're concise, they're to the point, they're well written. And just last year at Dana Chair Dillon's recommendation, we changed the format and structure to be absolutely consistent. So you'll also see that where we bring them back, just simply moving wording around to change and follow the absolutely same format. Policies may be boring, and I can contrast that with, I know for well, a peer that I worked at, state of Washington, and then other funds here in Sacramento, where their policies are notebooks thick. 5 binders thick. And what we've done is actually written them concise, to the point, and given you a glossary to really help you. So the bottom line, the board's going to laugh because you hear me say this all the time. It's a marathon. It's not a sprint. I don't know if anybody's a runner, but I'm not. I ride a bike, but I'm well aware we ride bikes, once a year, maybe for 60 miles, and you realize each mile does not matter. It's just the pace. So when we report 1-year returns, you need to always stop and realize, I'm sorry, but a year doesn't matter. We have a 30-year investment horizon. And oh, by the way, as you know, once a teacher retires, once they've hit the age of 60, they're going to live longer than any other workforce in America. As Dana and I joked on Saturday, we have over 340 retirees. They're over 100 years old. So to them, that really shows our horizon. So as much as we want to zero in on quarterly returns, semi-annual returns, calendar year returns, we always got to back up, and even a 3-year period. And I need to correct this. We're now 104 or 5 years old as a fund. A 3-year period is awfully short. So we'll look at 5 and 10-year returns. So backing away, here is the U.S. stock market all the way back to the Depression. I do have this slide actually going all the way back to the Civil War, thanks to Yale University. But a couple things I want to point out here. Very busy, but I think it's very educational, particularly for the teachers in the back. Notice that the red lines, there aren't that many of them. Even though we always are fearful of bear markets, there aren't that many. And there are really only about 4 that go well below 10%, down close to 20%. And we remember those times. So the far end of the chart is going to be the Great Depression. The middle of that chart, those 2 drop bars, are actually the 73-74 bear market. Whip inflation now, stagflation, all of that. Then you come up to the 3 drops in the internet bubble, obviously 9/11, and then 2018, which only really rivaled 1930, I think it's 29, and then, or 31, and then about 36. Look at the yellow line. That's the average over this extended time period. And again, notice the blue bars never actually hit the darn average. So the thing you're going to hear from us in the asset allocation is you guys are used to a traditional bell curve where the half the population is in the middle of the curve, and that's the mode and the median. That is not true in stock investing. It almost looks like a two-hump camel. The average is around 8 or 9, but you know what? You're more likely the mode is going to be somewhere up at 12 or down at about 4. And that's what makes life so challenging, is you're not going to actually hit that average all the time. The portfolio is definitely grounded in strong academic theory. I always like to bring that up because we get a lot of criticism. I remember when The Economist blasted us for our capital market assumptions, and I thought, boy, of all that magazines, The Economist, really? We're simply looking at modern portfolio theory. Harry Markowitz, he did his work in the 1950s. He got recognized till the 70s when it was really adopted and put into work. He won a Nobel Prize in the 90s. I am thrilled to say Harry Markowitz is a California resident and still alive. I think he's going to be 96 this year. And I haven't confirmed this, but I've been told he lives next door to a retired teacher in San Diego. So I have tried to get him to come up and talk to you, but Harry doesn't fly commercial, and we only fly commercial. So we haven't figured that out. I may have to bring you to him at some point at UC San Diego. But we use rates of returns from Ibbs and Singfield. We talk a lot about the CAPM pricing model, which is Bill Sharp. And I'll point out Paul Rosensteel, our member, actually gets to have lunch sometimes quarterly with Bill Sharp, took classes from Bill Sharp, who's at Stanford University. So it's very much grounded in solid academic work based in Nobel Prizes. This isn't, it's science, but as you'll hear from me a lot, it is still art. Despite all the science, we still try to apply. And maybe you can think about medicine. You think about all the power that medicine has, but a doctor's decision is still somewhat judgment, as much as we're trying to make everything computers these days. So asset allocation mix. This drives 95% of the explanation of our return. We're going to spend a lot of time on that. That is the most important decision you make. I can't say that enough, and you're going to be mad at me because you're going to hear that about 5 times today and for the next year, but it is the most important decision. I often say to the teachers, and I got to speak to the CTA Retirement Committee on Saturday, we're a giant cruise ship. We're huge. We're 220 billion. We're always at sea because we never reach port. We never reach our horizon. As soon as we get 30 years from now, we'll have another 30-year horizon. You pick the dot on the horizon that we're aiming for, and that's that asset allocation. The staff and I run the ship and decide when to batten down the hatches, maybe make some subtle course corrections, but we can't spin this ship on a dime and we can't stop it. We need to constantly keep going. We're always out to sea. I like to use the cruise ship for us because it sounds more fun than other types of boats. Here's your asset allocation. I think what's important to know is you look back into the 80s and you realize we were 80% fixed income, 20% equity. Glenn Hosokawa lives for those days again. And that's from the legal list and from the rules. So you only had about 20% and it was all US stocks. Then the 1984, the state law passed. So the boards quickly made changes from about 84 all the way to 99, 97 roughly. You were about 50% stocks, 50% equity. What's interesting to note during that time period is that's the 80s and the 90s when stock returns were huge. I'm sad to say that CalSTRS as a fund dramatically underperformed. It actually ranked 4th quartile near the bottom decile for almost those 2 decades. What's also interesting is that the board's asset allocation mix targets were 70-30, but what was implemented was only 50-50. In 1997, that caused a big change for the board where they hired a governance consultant, changed the way the investment staff was organized, and as you can see, brought in a new CIO in 97 and instantly changed back to a 70-30, 70% bonds, 70% equity-like investments. You can also see real estate show up and get big and small through that. You can see the light blue, which was non-US, which we thought was a separate asset class, and then in 2000s, we decided it's not and just made it part of stocks. You can see the purple growth, which is private equity. And then look at the last decades. We've roughly been about 80-20, so a complete reversal from 2080 or 80-20, now we're 2080. 80% equity-like investments and 20%. And the upper part of the graph isn't just fixed income. It's become a basket of RMS, cash, and fixed income that balance the portfolio. Quick view of the investment branch, which is a bunch of the leaders are seated behind me. Think of us as basically two halves. It's structured now very much like a money manager you would see at any big institution. One half is considered the front office, which is the asset management side under Scott Chan. The other side is what we consider the middle office, which is led by Deborah Smith. Then we would consider the back office is what Julie leads, which is our CFO for the fund, which then runs all of the accounting. I just want to highlight, we do run $100 billion, actually $110 billion here in West Sacramento. We are the largest money manager in West Sacramento, in case you were wondering about that. But we're not the biggest in our city. We are the biggest on this side of the Sacramento River to the West Coast. But as a joke, we do actually rank, we would rank in the top 100 money managers in the world if we were just our own separate entity. And the one thing I'm going to need to lean on you in this coming year, you know, for the trustees that have been here a long time, our staff is incredibly diverse, 50% male, 50% female, over 1/3 ethnic diversity. But we don't get counted as an asset manager when people ask us to do business with diverse managers. So we have to figure out, how do we incorporate that in? It's a very complex portfolio. I'm not going to go through all the holdings, but it's incredibly diverse. I've sometimes raised the question, maybe it's almost too diverse. But over 5,000, 6,000 stocks around the world, almost 4,000 bonds, real estate properties, predominantly the USA, but across the world, partnerships, inflation funds, which really are timber, commodities, infrastructure. And we are in about 44 countries, which is amazing, but it is a global portfolio. And nowadays, when you think about, obviously, Samsung, LG appliances, I used to say Nestle, Royal Dutch Shell, which is Shell gas. You know, America is very much used to products from around the world, Samsung being probably the largest. One thing that might help you understand is how do you monitor this portfolio? We live it every day. Every 4 years, you do an asset liability study, which is this year, you'll be doing it. Annually, you get investment policies, a business plan, a 10-year financial plan from me, and the review of your delegation to the staff. That happens annually every July. Twice a year, semi-annually, you get performance reports on all facets of the portfolio. Those are built by the custodian, which is the book of record, and presented by your respective consultants, and then staff comments on them. That's going to happen at the March meeting and the September meeting on your current schedule. And you have an open session where we talk about asset class levels and performance for the public, and then we have a closed session where you can actually get specific about managers. You also get a semi-annual rating on all the investment managers. We have over 220 investment managers that the staff runs, but you get our rating of them on how well they're doing. And then also semi-annually, we report activity reports that are posted on the web for the public to see. Every meeting, I give you a CIO report. So that's 6 times a year, and we'll go through that later in the agenda. And then mid-month and monthly, so sometimes weekly, sometimes, as the board members know, 3 times in a day. You'll get emails from me, at least monthly, about what's going on in the portfolio, what's our asset allocation, what's going on in the economy. I share an economic book with the board. And then during crisis times, I'll actually pick up my communication. And what you have to realize is you'll hear from me, not morning, noon, and night, as I like to say. You'll actually hear from me midday, night, and morning, because the sun, basically the trading day starts in Japan at 5 p.m. our time. So there have been times I've emailed the board at about 5 or 6 o'clock on a Sunday night, because that's actually the start of the trading day. Europe opens around 11 to midnight our time. And then New York opens at 6 in the morning, 6:30 when it starts trading. So California actually from 1 o'clock to 5 o'clock is when money sleeps. We're the graveyard shift in essence. But I'll try to keep you aware of what's going on, not just in the portfolio, but in the markets during volatile times, and not try and overload you too much with emails. In the book, I want to highlight, we have at-a-glances. As mentioned before, we do go through those with each board member. They give you a nice synopsis of every part of the portfolio. They give you the asset classes, a high-level picture of it, sub-asset class breakdown, our external managers, and it shows you the team. And obviously, we love to highlight our tenure, how long some of those people have been there. If you look down that, you'll see several names that have been here since the 1990s, or even one since the 1980s. And then we won't list the number of new employees who weren't born in the 1980s. But I want to highlight, and I say it every time during the CIO report for the members in the back, we have lots of information on calstrs.com. We're now going to shoot more videos. For the new board members, we have a video glossary, which Communications has done a fantastic job. So it's basically Investments 101. You can find a whole bunch of terms on there. It's videos of the staff themselves just explaining within 3 minutes what a complex term or a simple term might mean. And I'm always open for more of those. As you see those, send them to us and they'll shoot the videos. It's a great chance for the staff to be visible, but also to even communicate and educate. So we'll keep that live. Questions?
Thanks, Chris. Anyone with questions or comments? Ms. Dillon?
So Chris, even as long as I've sat on the board, this was a wonderful write-up. I really appreciate it.
Thanks.
But I think the one that I really appreciate the most is the history of CalSTRS. And updating that was probably no small task, and I really appreciate it. That's something that I keep with me when I go out to visit constituents. So thank you very much. I appreciate it.
Well, I want to give a shout out. She's not here, but a lady named Patricia Cade was actually an investment officer in the 1990s who started that. I remember we did an alumni day within the staff, and she came back and she said to me, "I heard you still use that report." And I'm, so she's actually probably the first 5-6 pages of that report. But yeah, I realize we probably have a little too much of the 2000s in there, so we'll condense that down. But I would add, just so you know, in that last 2 paragraphs, we would add CalSTRS, we won several awards again at the end of this year, CIO of the Year, Team of the Year. It was an awesome year for recognition, but I think that gives you the history. And I would highlight, way back to 1983, Tex Paco. I call it our black eye, but we are one of the few boards that ever had a trustee steal money in our history. And that's also, I joked with Stephen McCourt earlier, that's why you're a committee of the whole, is because that incident in 1983 where you just had 3 trustees. So. On that positive note.
We're not.
And we won some awards this year.
I don't know.
Don't steal money. That's good.
Here's a question. I guess maybe it's a request. I think it's slide 12, Chris. It's the allocation mix when we're 2080 and now 80-20.
Yeah.
Is that one?
Yeah.
You don't need it now, but at some point it might be helpful. What I'd love to be able to see is a chart during that same time period that showed the number of active and versus retirees. So what was the ratio of active to retirees in 81 when we were 80-20 versus what's the ratio of retirees versus actives when we're 2080?
It was about 7 to 1, actually.
Yeah.
The other way.
Yeah.
Actives to
About
retirees.
7 to 1 at the beginning of that chart. It's clicking. We're going to slide into 1 to 1.
Yeah, so I'm sure
Yep.
it's obviously not something that needs to be done immediately, but as a visual learner, I would love to see how that,
Can we have it?
yeah, I'm sure you guys have
Use in all
it.
our speeches. Yeah.
Yeah,
If you look at that line at the beginning where it breaks from 50-50 to 70-30, that line is when we went to a negative cash flow, where we started paying out more in benefits than we get in contributions. So for the first time, instead of a net buyer, we were a net seller all the time.
because part of how I try to think about the system is being a mature system and what are the implications of being a mature system and how to mitigate that risks. And so I think it's for me personally, it would be helpful. It might be helpful for others as well. Okay, thanks, Chris. I don't see anyone else. Oh, I do. Mr. Rosensteel.
Thanks, Jerry. Yeah, I think that was a really interesting comment, because I think first of all, this is great information, and this particular slide, I think, is really informative. But, I mean, if we look at the things that David and Rick are telling us, and our actuaries, as we get more mature, the funded status, as I understand it, for a change in investment returns, there's more volatility in our funded status. Is that right? Yes. Got that right? Okay. So in a sense, you know, we should be, that might suggest that we should be moving towards a more conservative allocation as we have more risk that we have to face, but at the same time, our funded status is also factored in, and that kind of moves us in the opposite direction. So we've kind of got, you know, two competing sort of facts in front of us. And I think when we do the asset allocation, it's really going to be kind of balancing off those two things, right? As we decide how much to allocate towards riskier investments versus less risky investments. But so, yeah, I mean, if this were superimposed on, you know, those risk measures and our funded status, we'd have one graph that kind of summarizes everything in front of us.
We probably could do that.
And appreciate that, Paul, and it's similar thinking on it. One last slide I'd like to comment on. It has the 100 years of the S&P 500 with the bar charts where it's a lot of blue lines up and a few red lines going down. I think it was 10. Yep, that one. You know, what's interesting about this slide for me is I was on the board in 2008. And and it ties in somewhat with what Paul was commenting on. And I think about that, and I think about the asset liability study that we're going to be doing over the next few meetings, and the types of, you know, what's the level of risks I'm comfortable with and what we collectively will be comfortable with. If I was just to look at that, I would be like, well, I've got a lot of blue and very little red. But if I recall correctly, that one drop in 2008 wiped out 10 years of blue bars. So 1 year of losses, drawdowns, wiped out 10 years of blue bars. So that can be a little deceptive.
Oh, very much so. It is simply a chart of calendar year, and you'll hear from us tell you all the time that time period matters a ton. But it was intended just for you to understand, because the world thinks so much in individual years, just the unique challenge in front of you, because we're so used to bell curves, and unfortunately, sounds strange, but life is not a bell curve.
And that basket changed so differently over the years. Chris, do you have a rough idea of what % of the S&P 500 in 2018 was in the S&P 500? I mean, at the beginning of your chart. I mean, this is a hugely different basket.
No, I don't. That's a great question. I can get that. I know the Dow 30 is virtually turned over. I mean, I remember in the 1980s when I started the business, International Nickel, International Harvester,
Yeah.
those were stalwarts. GM were stalwarts, Gulf Oil in the Dow, and now those have, you know, McDonald's, Apple, all kinds of names. So, but we can get you how that has changed. I don't go back to Civil War, because then you're dealing with America as an emerging market, then a stabilizing market. This is really when America's been at least generally a developed and the #1 economy, and it gives you that history.
Thanks. Paul, did you have anything else?
No, thank you.
Okay. All right, thank you, Chris.
Sure.
Item 4 is the Investment Insight Speaker series. Our speakers come on up, and do we have a staff member that's going to introduce them? Yeah. Thank you. is it Mr. Rismiller? Yes. Welcome, Mr. Rismiller. And Lazara, Ms. Lazara, welcome to the CalSTRS Investment Committee. Chris, you want to have any comments? Their bios are in the agenda for everyone, but you
Yeah, no, thank you very much. These are two of our, the absolute premier economist services. Most of the economist services have moved away while Merrill Lynch and Morgan Stanley still promulgate opinions on the economy. We subscribe specifically to private services that give us insights on the economy, on global markets, on where risks are. Both of them come and speak to the staff once a year. And I thought we'd take that opportunity to have them come and speak to you this time. Nancy and Don normally come with a 100-page flip book of charts, but those are proprietary because that's part of the service that you pay for. But I've asked them to kind of go through their outlook, what are the indicators they look at, where they see the world. I really want to open it up to questions from the board. I know them well enough to know they're happy to have you interrupt them and ask them questions. They're both consummate professionals. Nancy is frequently named the #1 macroeconomist by Institutional Investor, by everybody in the world. Don and his firm are frequently highlighted on CNBC and Bloomberg as some of the best. Their insights to us are invaluable. But I also know they are consummate professionals. While I would love for them to argue about GDP forecasts, I know they won't, but it would be helpful for you to bring out, contrast the differences in their outlook because they're economists. They're trying to predict the future. And last I checked, it's not an exact science. So with that, I will turn it over to have Nancy go first, probably talk for about 15 minutes, and have Don talk for about 15, and really open it up to you guys for at least 15 minutes of Q&A. So welcome to the CalSTRS Investment Committee. You press the little push button to turn on your microphone, and as I mentioned to them, they are broadcast live on the internet, so what they say will be published.
Thanks, Chris. So before we turn it over to the two of you for your presentation, what I'd like to do is have Nancy present, then Don present, and then we'll do questions after the presentation. So committee members, if you could take notes or put your questions on, I think in terms of managing the entire meeting throughout the entirety of the day, that would probably be most helpful. So Nancy, we'll turn it over to you first.
Perfect. Thank you very much. And Chris, thank you very much for those nice words and also inviting us to participate today. So before I begin, I would like you all to close the book on the way you viewed the world. Please, let's take a minute and think of the world very differently. What I'm going to argue is the United States is indeed the supertanker of the world. We are driving global growth. And I think that's actually continuing and incrementally can be better than what is potentially commonly reported in popular press. GDP growth had averaged 2. We've now shifted up to 3 in 18. Maybe we're going to be 2.5 to 3, at least in 19, maybe even a little longer than that. Second is China. China, however, is the speedboat. And they've created a lot of volatility. I loved Chris's boat analogy. I had no idea he was going to use that. China is this speedboat. They're more still an emerging economy. Policy is very immature, very volatile, and has created the volatility in the economy, particularly this expansion. But we are the supertanker and getting healthier. I didn't say there aren't problems. I know there are. But we're at the margin improving. So third is that we don't see a recession anytime soon in the United States. We have led the world into recessions in 2001 and 2008. And so that's a very important part for the overall, not only economic backdrop, but I would also argue the stock market. China has, quite frankly, created an awful lot of volatility in the world and in turn in the markets. So we have a lot of models. And to be succinct, I would say there are really, at the end of the day, 2 big drivers of the economy. These aren't going to be any surprise to you. Monetary policy and fiscal policy. Obviously, underneath that, there are multiple things. Monetary policy gets too much focus because every day you read about what bond yields are doing, what the 2-year is doing, what the yield curve is doing, and not enough focus on fiscal policy. Fiscal policy encompasses more than just government spending, but it also encompasses taxes, tax reform. The United States has just experienced the biggest corporate tax reform in history. Reagan in the 80s put in place tax reform, but this is even bigger than what Reagan did. Why is that so important? What I'm going to highlight is companies actually create jobs, pay wages, and build stuff. They are the backbone of an economy. China saw that in the 90s and indeed lured companies to come into their country and invest to create jobs and build stuff. So the corporate tax reform, we were out of sync with the world. We had the highest corporate tax rate in the world at 40%. Many of our companies didn't pay it because they invested outside of this country. And those that were left at home who didn't have that ability, retailers, even banks, home builders, paid that 40%. We're now on an even playing field. Our domestic companies, which create those domestic jobs, indeed help explain why the job market in the United States has been as healthy. So yes, the Fed has been tightening, but the bottom line is we've also seen some fiscal stimulus to this economy, which certainly helped the economy in 2018, and we think it's going to help us in 19 and probably even into 20. Companies can't make decisions very quickly, and so the lagged effects of these reforms is indeed going to continue to support capital spending and jobs in the United States. This is a little bit of a minutia, but I know you all certainly are aware of some of the popular data that come out. But last week, unemployment claims, which is a number of people who sign up for unemployment, it's a weekly data point, came out. It hit the lowest level in 50 years. 50 years, despite the turmoil we see in the market and out of Washington. Son of a gun, the economy is actually doing much better than, again, the popular press. So we're using about 3% GDP, 2.8% GDP this year. Consensus is a little less than 2.5. Last year we were 3.1. Relatively steady growth for the U.S. Economy. To be sure, what I just highlighted is not being reflected right now in confidence. Both business and consumer confidence have gotten hit. In my world, that's called soft data. It's expectations. Expectations are much more volatile, a little bit like a teenager, than the underlying trend in growth. And so you have to be careful. When expectations get too exuberant, watch out. And when expectations get too bearish. I believe expectations today are way too bearish. Actually consistent, according to our metrics, with a 0 GDP growth. So even if I'm wrong with my 2.8% number, I don't think we're going to be 0. So I think you're starting to see that actually now reflected, be it in the market, but that you'll also see that in data. I said GDP growth right now or last year was about 3, maybe a little less than that this year. But corporate profits over this expansion have actually averaged about 10%. That's before the tax cut. After the tax cut last year, obviously, there were even more. That was a one-time booster shot to corporate. But corporate profits, this expansion, have actually been much more rapid than the underlying trend in U.S. GDP growth. That's crucial to the sustainability of jobs and investment in this country. And the fact that companies today domestically, not just the big multinationals, but domestic companies can now incrementally have a higher after-tax return, increases the odds. The job market in 2018 was much stronger than anybody expected. The unemployment rate's gone from 10 to 4%. That's not easy to do. Ask Europe. We've been able to lower our unemployment rate, pull people back into the labor force, which increases the odds. Consumer spending stays relatively healthy. But the real area of the economy I want to spend a minute on is capital spending, underappreciated as an important driver of growth. How many of you grew up in the Midwest? Okay.
There you go. You're talking to a West Coast crowd.
I see some hands back here. Pardon me? I grew up in a factory town. In the Midwest. And my grandfather came from Iran and settled in Flint, Michigan, and worked for General Motors. Next thing I knew, he was a home builder. And I didn't know that. And the next thing, he opened a restaurant. My dad goes to school and becomes a pharmacist. Nobody in my family has actually ever worked for General Motors, even though we lived in a General Motors town. Because from investment, there's a multiplier. I left Flint, Michigan in 1981 because there were no jobs. It's dead as a doornail. For the first time in 40 years, GM is building a factory in Burton, Michigan, which is actually where I grew up. There's been not an investment dollar in that town in 40 years. Now, Kentucky Fried Chicken is the first new restaurant in my hometown in 40 years. It's stunning. You've just started to see growth, rebirth to certain areas within Michigan because companies are reinvesting. Capital spending is underappreciated. It's 14% of GDP. Housing is 4% of GDP. Consumer spending is, to be sure, almost 70% of GDP, but companies hire people. So that investment is rejuvenating. Let's go to New York. In New York, we're getting Amazon. Amazon is putting a new facility in Long Island City, one of the few areas in New York that has not been developed. It's really cool, the jobs that are going to be created. So from companies investing, you get more jobs, and you've seen something unique this expansion. The unemployment rate has gone from 10 to slightly below 4%. Stunning decline in 10 years. Again, Europe has not been able to do that. We've done that. And even now, we're starting to pull more people back into this country. In my world, something called the labor force participation rate for prime age workers is going up for the first time in almost 15 years. It was declining in an unprecedented fashion because we stopped investing in this country. We put everything over in China. Nothing wrong with that. But if you put everything in China, you diminish the job prospects domestically. And now that investment's coming back because China's not so attractive. And now then we have this corporate tax cut. So we are getting more people into the labor market. The number of people on disability has actually declined for the past 3, maybe 4 years. The number of people, the actual count, because the community, the business community, the labor market is tight, is more willing to hire that incremental worker. That perhaps in the old days they didn't have to do. But the longevity of this expansion, which is now 10, is going to be 11, I would argue 12, 13 years, we're not done, is going to further pull these people back in the labor market. I visited a prison a year ago. Why? Because this prison is in Michigan. This prison is educating inmates. They get released, they are getting a job. It is so cool. It's one of the most humbling things I've ever seen in my life. And the fact that these guys are getting jobs. So please don't discount the United States. I would argue we are being thrown under the bus at a time in which this economy is incrementally becoming, we're not there yet, we've got too much government debt, we've got some other headwinds, I don't disagree with that. I know there are problems. Everyone's well aware of those. I'm just trying to give you a different perspective. Let me now switch for a minute to China, because China has created a lot of these headaches. I said at the beginning that the United States is the global supertanker. We create the real big swings in the business cycle, recessions, and then expansions. China has become a very large economy, but second largest in the world, but they're a speedboat, in part because their domestic monetary policy and fiscal policies are very volatile. A couple weeks ago, they announced they're going to increase rail investment 40% here in 2019. What? 40%? The second largest economy in the world? You can't do that without creating volatility. It's actually good news. It'll help global growth, but it's too much. Last year, they cut rates 200 basis points. The year before, they raised rates 200 basis points. I don't know, Glenn, what you think about if our Fed did that. I mean, it would create havoc. Well, it does. Not necessarily to our economy, to the financial markets. Because a lot of the companies within the S&P 500 are touched by China. And China touches Europe. Europe sells a lot of stuff to China. And so when China increases the volatility globally, which they've done this expansion, keeps me busy, but unfortunately, it creates extreme swings in global expectations. As China eased back in 2015-16, the global economy popped 16-17, expectations got huge, and then we were disappointed. They tightened in 2017, China slowed in 2018. You can't make this stuff up. For the second largest economy in the world, behaving like a speedboat really affects corporate profits. So listen, you saw Caterpillar earlier this week. Apple, they're getting squeezed because of China, because that's been the driver of a lot of growth. But I think that's starting to end. So I said at the very beginning, look at the economy very differently. China was the driver of global growth because they grew from 6 to 10 to 20, 24% growth in Chinese nominal GDP, 10 to 15 real GDP growth, multiples of what we could ever grow. But that's ending. China's boom is now fading because they now have way too many excesses, even compared to us, and they're having to rebalance. That rebalance is tough and creating global volatility, but it doesn't mean you're going to have a global recession. A lot of companies are touched by China, so that affects the stock market. But at the end of the day, what matters, and we've studied this a lot, we went back and studied every recession back to 1960, looked at over 100, 150 economic variables, and put together our own recession risk index. It's 12 variables. There are a lot of 1 or 2 variable recession risk indices. We're complicated. The Fed doesn't just create recessions themselves. It depends upon business conditions. And business conditions are actually pretty healthy. Productivity is improving, containing inflation. Companies have done a great job refinancing their debt. There's too much corporate debt, but companies are refinancing it. So when we try to determine when are the highest odds of a recession, and we don't do this lightly. I've got a group of about 6 people working with me back in New York. Our conclusion is the highest odds of a recession aren't until the back half of 2021. And I'm not going to pound the table on that because it's not clear we're going to get there. It's not just the Fed that creates recessions. It's domestic economic excesses like inflation. But our companies are doing a great job investing in this country, improving their productivity, containing inflationary pressures. And that, at the end of the day, is one of the most important, underappreciated supports for U.S. economic activity. Again, businesses are the backbone of an economy. They hire people, pay wages, and build stuff. And if you stop investing, you die. Pardon me, I give you Sears. And they stopped investing, and they couldn't keep up with Amazon. Walmart figured it out. They're back to investing, and they're doing much better. I'll stop. But California has been a huge beneficiary, leading edge in improving productivity and investment. And the good news is, with this corporate tax reform, you're getting smaller, medium-sized companies who now have a shot of reinvesting in their businesses and in turn helping to create more, better jobs, luring people who in the old days couldn't get a job. So yes, close the book and look at the U.S. a little differently than maybe what you read classically in the newspapers. So thank you.
Okay, thank you. Appreciate the chance to talk to the group today, especially because being out of New York, I'm avoiding the polar vortex. So very happy for that. So I'd like to pick up on the idea that there's not a recession coming. I would agree with that. I would like to highlight some of the later cycle phenomena that could be occurring over the next few years, though. So if we get to this summer, we'll essentially hit the longest cycle the U.S. has ever had. It's not the longest cycle any economy has ever had. There are economies like Australia that have gone over 2 decades without a recession. So I don't think recession is the right focus, but let's talk later cycle. What we should start to see is employment growth, which has been very robust, start to slow down. We don't need to add 300,000 jobs a month to keep the unemployment rate flat. In fact, a number closer to 100,000 would probably be the right number to think about as a steady state. So we should see employment growth slow down over the coming year. What we should also see is wage growth continue to pick up. Now, this has not happened very quickly, but with the unemployment rate below 4%, we do think you're near some estimates of full employment. So slowing employment plus rising wages should overall start to increase the labor share of GDP. If there's an inflection point to think about, I don't think it's the recession call that we want to think about. It's a rising labor share. We're at the part of the cycle where from here, the GDP that's generated is going to go in an increasing fashion to labor. That's what happens when unemployment starts to become low. So when unemployment was 10%, that first dollar of GDP that was generated went to capital. When unemployment is 4%, that dollar is going to start to go to labor. And that's an important item we think to consider for the investment thesis. So we do think we're slowing. We think we're still growing. We would have a better GDP estimate if it weren't for some of the disruptions here in the first quarter. That's taken a bit off of what we think will occur in 2019. Some of those are self-inflicted wounds coming out of DC and elsewhere. Consumer confidence has been volatile, and some of the interest rate sensitive sectors, like existing home sales and new home sales, have started to decline. We could add that to some of the volatility abroad in China. But we do think we're going to do a lot of things right. We think the government will stay open, tax refunds will go out. That's going to matter in the near term. We think China is going to employ more stimulus at the end of the day. We do think you get a trade deal with China. That's not going to be a linear process. This isn't easy, but at the end of the day, that should be a positive. Some survey data has started to bottom out. Recently, we're going to watch the manufacturing sector carefully from here. That should start to offset some of the weaker confidence data that has occurred, or we'd look for those confidence numbers, which are mainly driven by expectations right now. It's not the present situation component of that data that's suffering. It's the expectations that have been volatile. That should bounce back if you remove some of these self-inflicted wounds. Sometimes it feels like we're trying to talk ourselves into recession, given what we see in the media and elsewhere. We looked back historically, we've never really done that. We don't just talk ourselves into recession. You have to see unemployment rise up to about 0.5% to get the recession. So you need actual business leaders making actual business decisions that are hard. You need to see the firing pick up to get the recession. And whereas we've had some items that have increased uncertainty, we don't see businesses making those decisions to fire, and that's what gives us some room to operate here. The Fed, we think, does matter. There's obviously a meeting today. The issue we see is the interest rate the economy can take is probably higher than the interest rate that has made financial markets comfortable for the last decade. So whereas we've had some financial market volatility as interest rates have started to rise, I don't think outside of some of those sectors we talked about, like housing, it is that large an impact because the economy in the US can probably take it because we have some of those fiscal tailwinds. The concern is the path of getting the interest rate the economy can take and the interest rate that makes financial markets work to match is going to be a volatile process. This has played out over the last several quarters. We're probably not done with that process. We only get one interest rate in the economy. So at some point, those two numbers are going to have to match. We would hope that that occurs slowly. So as interest rates have risen, we've seen market volatility. We think there is some more of that to come, but key is going to be that those interest rate increases slow down. The Fed raised interest rates once in 2015, once in 2016, then they started to pick up the pace. They went 3 times in 2017, 4 times in 2018. I'm not sure they have much more to go here. A hike this year, maybe one more after that next year, and that should do it. We think we're pretty close to a neutral interest rate, and global conditions do not argue for any rush. Inflation is another item I'd want to consider. Because we're later cycle, we would want to start talking about inflation, but I don't want to overemphasize it. I think the hard part is to start having the inflation conversation without jumping to the 1970s. It's nothing like the 1970s. Yet, for the first time in a while, we probably have to put inflation on the table as a variable to watch. We've seen the unemployment numbers. We've also seen capacity utilization start to rise. We've seen supplier delivery times start to slow down. So there are some impulses for inflation, but they're mainly coming from good things. They're coming from the economy doing well. They're coming from us getting too many orders in some cases. So it's not de-anchored inflation expectations. It's not a big supply push. If we look at the inflation pipeline, there's not much there on the producer price side. So inflation probably is turning some sort of corner. We want to acknowledge that, but we don't want to get carried away and say this has to rush the Fed or create an interest rate profile that has to be all that damaging. I think we can get this right. I think the Fed can get this right. If there is an investment conclusion from this, it's that being later cycle with this type of environment, what I'd like to drop is the term Goldilocks. I don't want to use that anymore.